Hello, everyone, and thank you for joining us today for our webinar. Today's topic, revenue recognition, what it means to the manufacturing and distribution industry. My name is John Giordano. I am an audit partner with the firm Citrin Cooperman in our New York office. Today with me are speakers Peter Brown and Mark Henry, partners out of our Braintree, Massachusetts office. Whenever delivering a topic on revenue recognition, I often refer to us as messengers. The objectives we hope to cover today in our 30-minute webinar, staying at a high level, is an overview of ASC 606, how it affects the manufacturing and distribution industry, a summary, and the proposed next steps. Again, we will be staying at a high level, so any questions you may have, we've included our contact information on the previous slide. The primary objectives of Accounting Standards Codification, or ASC 606. What the Financial Accounting Standards Board, or FASB, and International Accounting Standards Board wanted was a unified, principles-based approach. The goal was to eliminate a lot of industry-specific guidance surrounding revenue recognition and create a level playing field, if you will, amongst filers. ASC 606 is the culmination of 12 years of work on this joint project between the FASB and the IASB. The main provisions of it are to provide a more robust framework, improve the comparability, and provide more useful information to the investors or users of the financials through enhanced disclosure requirements, which we will speak about later on in today's webinar. Outlined for you right now, which I will go through, are some key dates to know. For public companies, they are already in the process of implementing ASC 606 since it was effective for them calendar year 2018. They have been filing their quarterly reporting, their 10Qs, and this will be their first fiscal year end of implementing 606. For private entities, they are required to be implemented for the upcoming calendar year 2019 or any financial report that are beginning after December 15th, 2018. Earlier entities are permitted to adopt earlier if they so choose. One item to note is that although this does not cover international financial reporting standards, IFRS 15, which closely allies with ASC 606, was required to be implemented on January 1st, 2018. We make mention of this here for any companies that have a foreign parent that requires reporting under IFRS. As I stated earlier, the crux of ASC 606 is principles-based. The core principle of ASC 606 is to recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. Some key things to consider when talking about the transfer is when a customer is taking control of the asset. When we talk of consideration, what will ultimately be paid for those goods or services that are transferred to the customer, which closely ties into the expectation of what the company expects to be entitled to. Some things to consider when talking about consideration are volume-based discounts, rebates, and others, which my partner, Mark Henry, will elaborate more later in our presentation. Now I'd like to hand it off to Peter Brown from our Massachusetts office. Peter?
Thank you, John. The next part of our presentation, we will be talking about the five-step model. As John mentioned, one of the primary objectives of ASC 606 was to develop a unified principle-based standard in which all industries will recognize revenue. Regardless of the industry you're in, whether software, construction, or non-for-profit, you will be applying the five-step model that's outlined in ASC 606. On this slide, we show the 5 steps that you will follow. Step 1 of the core principles is to identify the contract with the customer. Step 2 is to identify the performance obligations in the contract. Step 3, determine the transaction price. Step 4 is allocating that transaction price to the different performance obligations. And step 5 is the satisfaction of the performance obligations. We will now walk through the 5 steps. Step 1 is to identify the contract with the customer. Establish whether a valid agreement exists between two parties. 606 defines a contract as an agreement between two or more parties that creates an enforceable right and obligation. This is very much a legal term. The contract can be written, oral, or implied by an entity's customary business practices. An example of an implied contract would be a customer that has the ordinary customer business practice of allowing someone to return goods or services 15 days after they receive it. This is not written in the contract, but is their customary business practice. This would therefore imply a contract with the customer. Step 2 is to identify the performance obligations in the contract. Topic 606 defines a performance obligation as a promise in a contract with a customer to transfer a good or service to the customer. In other words, we must first identify the promise in the contract, then evaluate and determine which promises represent separate performance obligations. This can be a complicated thing. Step 3 is determining the transaction price. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or service to a customer, excluding amounts to be collected on behalf of a third party. What's new in 606 as compared to legacy GAAP is you can see that it's what the entity expects to be entitled to. So this gets into the concept of variable consideration, which we'll talk about in the next slide. Determining the transaction price. This slide depicts some of the elements that can go into determining your transaction price. Obviously, fixed consideration would be the simplest of them. Variable consideration is a new concept within 606. Some examples of variable consideration are incentives, performance obligations, rebates, and discounts. If you have a finance component within the transaction price, non-cash consideration, consideration to customers, and sales tax would not be considered part of the transaction price. In determining the transaction price, some of the more common features of variable consideration are royalty agreements, volume-based and other rebates, performance-based bonuses or penalties. Under the new 606, you will recognize variable consideration in your transaction price. There are two methods you can do to calculate the variable consideration. One method is the expected value, or the most likely amount method. Step 4 is allocating the transaction price to the performance obligations. To meet this objective, the transaction price must be allocated to each performance obligation on a relative standalone selling basis, meaning the price at which an entity would sell a good or service separately to a customer. If they do not sell on a standalone basis, it should be estimated an amount that depicts the amount of consideration the entity expects to be entitled to. The standalone selling price should be determined at the contract inception. Satisfaction of the performance obligation. Within this framework, satisfaction of performance obligation is obtained when control is transferred to the customer. The standards define control as an entity's ability to direct the use of and obtain substantially all the remaining benefits of an asset. Control should be viewed from the customer's perspective. Under legacy GAAP, control was not a consideration. You would recognize revenue under legacy GAAP under the 4 criteria that are shown on this slide. In order to determine when to recognize revenue, you're either going to recognize revenue over time or at a point in time. As you would think, goods are generally transferred at a point in time when services are usually transferred over time. If a performance obligation is not satisfied over time, it is satisfied at a point in time. Within 606, they give some examples of when control would be transferred. The entity has a present right to payment for the asset. The customer has legal title to the asset. The entity has transferred physical possession of the asset. The customer has a significant risk and rewards of the ownership of the asset, or the customer has accepted the asset. Control of goods service transferred over time and therefore satisfies performance obligations and recognizes revenue over time if one of the following criteria is met. The customer simultaneously receives and consumes the benefit for the entity's performance obligation as the entity performs. This would be similar to a service when you're performing payroll services or cleaning services on a monthly basis. you would recognize the revenue over time. The second criteria, the entity's performance creates or enhances an asset the customer controls as the asset is created or enhanced. You can think of this within the construction industry, where you're doing a customer renovation. The customer receives benefit as you're performing the obligation, and they also control it. The third one is the entity's performance obligation does not create an asset with an alternative use to the entity, and the entity has an enforceable right to the payment for performances completed to date. You will see this in the contract manufacturing industry, where a company hires a contract manufacturer to manufacture specific goods within their requirements. The entity cannot sell it to anybody but that customer, and the entity usually has the right to payment if the customer was to stop the contract. In this situation, the contract manufacturer would recognize revenue over time. John, I will turn it back over to you.
Thank you, Peter. In the next section here of the webinar, we're going to cover some of the disclosure requirements that come along with ASC 606. Again, since it's principles-based, there's a lot of explaining to do. The objective of the disclosure requirements within ASC 606 is to provide the user with sufficient information to enable financial statement users to understand the nature, amount, timing, and any uncertainties of the revenue and cash flows arising from contracts with its customers. We will disclose both qualitative and quantitative information about the contracts, any significant judgments made, and any assets recognized from the costs to obtain or fulfill a contract. The disclosure regarding the disaggregation of revenue would be a breakout of the various revenue streams. Basically, how does the company make money? Companies may manufacture a product. They may as well service it, train the employees of its customer on how to use the product, or finance it, all of which could be separate streams requiring enhanced disclosure. One of the things that Peter had mentioned in his section is the transfer of goods or services at either a point in time or over time, of which he gave the example of a contract manufacturer, which could see a shift in its point in time versus over time accounting for revenue recognition. Qualitative information about how economic factors affect the nature, amount, timing, and uncertainty of revenue and cash flows, such as the type of customer, its geographical locations, and the types of contract. It could be a fixed price contract, a cost plus contract, or PO based, all of which will require enhanced disclosure under ASC 606. Speaking of principles based, again, we have significant judgments that need to be explained to the users of the financials. An entity shall disclose the judgments and changes in the judgments made in applying the guidance of this particular topic. The timing of satisfaction of performance obligations, the methods used to recognize the revenue, such as any output or input methods, which would align with the over time revenue recognition, which Peter alluded to, and Mark will provide more details on in the coming slides. The transaction price and the amounts allocated to performance obligations, which is the overall consideration, will also need to be disclosed, and any estimates affecting those. Okay, so now what? How do we transition from ASC 605 to ASC 606? The guidance provides for two transition options, which will make most sense for your company. One of the key things to consider when selecting a transition option is the impact and level of effort it will have on your company. Companies will have the following options: either a full retrospective, which we'll discuss, or a modified retrospective. Under a full retrospective, the entity shall apply the new standard retrospectively to each prior reporting period that will be presented within its financial statements. For example, if you issue comparative financial statements between 2019 and 2018, under a full retrospective, you will need to adjust all the numbers in the preceding year to be reflective of the new standard. The next piece of a full retrospective is you'll need to determine the quote, cumulative effect of applying the new standard as of the beginning of the first historical period presented, and recast the revenue and expenses for all prior periods presented. 4 optional practical expedients are available. If an entity decides to use any of the practical expedients, it must apply the expedients consistently to all of those periods that are being presented. A more practical approach, as most practitioners would say, is the modified retrospective. Under a modified retrospective, an entity shall recognize a cumulative effect change to opening retained earnings or members' equity accounts in the year of the adaptation of the standards. An entity may apply this to all contracts as of the date of the initial application, for example, January 1, 2018, or to contracts that are not yet completed. An entity shall disclose which approach is used. If an entity uses this transition approach, the prior year financial statements will be presented in accordance with its historical revenue recognition. Now I'd like to pass it off to Mark Henry from our Braintree office.
Thank you very much, John. So with everything being said and walking through our five-step model and the impact of RevRec and 606 going forward, you can embody that conversation and apply that to all different industries. But the point of today's conversation is really to focus on the impact of the manufacturing and distribution industries and our clients in that realm. So walking through, as we sit down and meet with most of our clients, the biggest issue we've come through is where do you get started? There's so much information to think of, contracts, purchase orders, handshake agreements. Where do you get started? What are the biggest impacts to me as a client? And what we found is that the best way to really get the conversation going and get people thinking about what impacts them is to give some examples. So where we want to start today is top 5 issues for manufacturing and distribution industry clients. And this doesn't encompass all of the things that could change with the implementation of 606, but these are some of the 5 biggest areas that we've seen so far. Warranties and post-delivery obligations, which are service warranties, rebates and prospective discounts, the timing of recognition, which John and Peter have alluded to before, repurchase options, and the sell-through method. So warranties, there's really 2 major types of warranties. There's an assurance or product warranty, and there's also service warranties. On the assurance or product warranty side, it's really making sure that the product your customer or your client is selling is functional, right? I bought a cell phone, it's operating as intended, and I can make my phone calls, and that's the purpose I bought this product, and that's what a product warranty encompasses. That is going to stay the same under existing guidance under ASC 450, and there will be no change to product warranties. Service warranties generally are extended warranties that are purchased separately or in conjunction with buying a product within the industry standards. And that can be from an appliance retailer, a cell phone seller, sporting goods, every single industry, it's going to be the same application. This requires the manufacturer to repair the goods if something goes wrong within that extended service warranty period and should be separately accounted for based on standalone price rather than the stated contractual price. And what we mean there is you may, in your negotiation with your clients, charge X for the product itself and Y for the service warranty, but the service warranty really needs to be accounted for separately in terms of fair market value for how you would charge that price on a standalone basis. So walking that through, examples, just to try to keep it very simple and get people thinking about how this will impact you. If on a product warranty, if you sell a product that has a standard 1-year warranty that it's going to be functional for that 1-year period, under this warranty, the company replaces any defective components of the product free of charge to the customer. There are no service obligations under this warranty. How should the company account for this warranty? And that's the same as existing guidance. There's no separation. You sell that product comes with a product warranty that it's fully functional, and you record the revenue for the sale of the product. There's no separate accounting. Service warranties, this is where it's going to get a little bit different going forward. A company sells a product with a standard 1-year warranty, that's the product assurance warranty. Under this warranty, the company replaces any defective products, any defective components of the product free of charge, similar to the example we just mentioned. But in conjunction with that sale, they also sell a 1-year service warranty to provide maintenance and repairs to that product. How should the company account for these warranties? And that's really where we get into separating these 2 components. You're going to establish a price for what the fair market value of that product is, and then you're also going to establish a price for what the fair market value of that service warranty is, and you're going to account for those separately. So the product sale could occur immediately in terms of revenue recognition. The service warranty will need to be separated and amortized over the course of a year. Volume discounts and rebates. So the way to really think about this is manufacturers that are offering rebates to its customers and then going to be paying those out. So a lot of M&D companies offer incentives to their customers via volume discounts or rebates. Under 606, an entity must identify if this represents a material right and therefore a separate performance obligation. Let's look at this on the left side and the right side of this table. So under current GAAP or 605, volume rebates are recognized as the customer earns the rebate. So as they go through their different tranches of earning a separate discount or a rebate, you're only going to record that revenue when it's fixed and determinable and they've reached that goal. Under 606, you're going to estimate what that rebate will be day one based on historical experience with that customer, with that industry, with that client base. However you come up with your examples on historical experience, you're going to estimate that day one. On volume discounts, they're recognized in current GAAP as a reduction to revenue when the volume meets the condition of the discount. If there's no reliable information available, revenue is reduced to the maximum possible amount. So volume rebates. A manufacturer has a one-year contract to produce sporting equipment to an end customer. The contract stipulates that the manufacturer will give a rebate to the customer if certain sales thresholds are met. Management believes at the inception of this contract that they'll sell about 1,500 units to this customer. So that's the importance of 606 versus 605. Under 605, that consideration is not done. Under 606, you have to estimate day one where you think that sales volume threshold will be. So walking through this example, you have different rebate thresholds that the customer could earn. 0% for 0 to 1,000 units in sales volume, 2% from 1,001 to 2,000 units, and then a 5% rebate for 2,000 and beyond. So based on this initial day one estimation process done by the client or the customer, they're going to be recognizing revenue based on a 2% rebate being recorded in the future because they estimate 1,500 units will be sold. So based on those facts and circumstances, this is how you would allocate prospective discounts. So we have different thresholds for what the prospective discount would be. The original sales price being $100 per unit times 1,000. If they met that first threshold, that's 100,000 in gross sales. If they met the full discount, you charge $900 for the $90 for the 500 additional units to get to the 1,500 total estimated products on day one of the contract. That's $45,000 in total consideration expected to be received at the end of the lifetime of this contract. So your total expected consideration day one before you sell anything is that you'll sell 1,500 units for a total of $145,000 in consideration. Based on those facts and circumstance, your total price per unit, your estimated total price per unit is $96.67 on day one, and you'll be allocating $3.33 to a deferred revenue account every time you sell this product. So on day one, you may be receiving cash for $100, but you're estimating that your purchase price, because you're going to be offering these discounts in the future, or your sales account is only $96.67. So you record a shorter amount of revenue, $96, and defer $3.33 into this deferred revenue account. As you see in blue below, after you get past that 1,000 unit threshold, and now you're in that 1,000 to 2,000 area where the 2% rebate is being earned, when you receive cash of $90 per unit, you'll start relieving the deferred revenue account for $6.67 and recording that as revenue. So now getting into recognition of revenue at a point in time or over time. And Peter and John alluded to a couple different examples of how it impacts you, and where we've seen this the most is in our contract manufacturers so far. So a manufacturer enters into a contract to create 100 units for a customer. The product takes a few weeks to manufacture, and during production, the company has significant work in process. So components of raw materials that are all being joined together to create a finished good. The product belongs to the customer through this entire production process. How should this be accounted for? And this is one that we've had a lot of clients where really digging into their contracts has changed some of the revenue recognition policies that they've had in the past. And this should really be done over time. The customer has control of that product. They own it during the entire manufacturing process. It's really their product. So that's why you can't recognize it until you get through that process. The next example.
A manufacturer enters into a contract to produce customized products for its customer. Under the terms of the contract,
1, most of the payments are due after installation. 2, product is customized to this customer, so cannot be sold freely. 3, customer can cancel the contract at any time, with the termination fee that's included in the initial contract. And 4, title to inventory does not pass until the contract is 100% complete. So during the entire production process, the product belongs to the manufacturer and not the customer. So the key point here is number 4. Title does not pass until the contract is 100% complete. So this sale would be recorded at a point in time after step 4 is completed. Rights of return and repurchase options. So where we see this the most is our clients that deal with manufacturing and machine equipment. So 2 common scenarios that you'll see is a company sells machinery to a customer and the company has a right to repurchase that machinery at a guaranteed price at a set period of time in the future. It's really an option to purchase over a period of time. If a company can require the customer to return the product, then title is not transferred and revenue can only be recognized after that option is expired. The product would be the company's inventory and any payments would be a liability until that title is transferred. The second scenario is a company sells machinery to a customer and the customer can request that the company buy it back at a guaranteed price after a specified time period has passed. If the repurchase price is greater than or equal to the original price and fair market value, then it is treated as a financing arrangement. If the repurchase price is less than the original price and fair market value, then it is treated as a lease. And the last example we're going to walk through is the elimination of the sell-through method. Now, some people may be using different terminology for the sell-through method, but the basic example where we see this with most of our privately managed companies is if you're dealing with a Home Depot, a Lowe's, some of the big box stores, and either in their contracts or just their normal practices with you, is that they'll return units. You could sell 1,000 units to them and they have the right to return that product. If it's not sold, it's not sold through to the end customer. And that's most likely the scenario that you'll see if you're in that situation dealing with the big box stores. So that under old GAAP, ASC 605, you weren't allowed to record a sale because at the end of the day, that product could be returned to you at any given point for any given price. Under 606, you do have the ability to recognize revenue a little bit quicker using an estimation model to determine what your historical experience has been with that customer, how much revenue you could recognize on day of sale, and how much would be returned to you. So based on historical experience, if you feel as though 10% of those goods are typically returned to you that are not sold through to the end customer, you'd recognize 90% of the sale on day 1 and record deferred revenue on the rest. So with that, I want to hand this over to Peter Brown, who's going to walk through revenue recognition, what to look for going forward, and other key impacts.
Thank you, Mark. The next part of our presentation, we're going to talk about revenue recognition summary and looking forward. Key considerations for transition. As most of you know, revenue is the largest number on your financial statement and often one of the most important numbers. In addition, it usually has a significant amount of transactions that is running through your general ledger, internal controls, and affects almost every part of your business. Some of the key considerations for transition are changes in the process of how revenue is recognized, changes to internal controls, your IT systems, contract wording. You might consider modifying some of your existing contracts to make sure you meet specific objectives that you're looking for under 606. John talked about the disclosures and the impact. There could be tax implications. You need to understand if you're going to change how you're going to recognize revenue for financial statement purposes, it could potentially impact your tax situation as well. Then you have to think about other institutions such as banks or bonding. If you're going to change how you recognize revenue, it could impact the agreements you have with these institutions. Developing an implementation plan. You want to assess the impact that 606 is going to have to your financial statement. You want to select a transition method. Some of the things we talked about is reviewing your internal controls. Will it impact your debt covenants? Do you want to adjust contract terms? We talked about considering the impact to your income taxes and the update that it might have to your estimates and other judgments in your financial statement. The last slide we have in our presentation are links to our website. We have designated a revenue recognition section to our website. In addition, there's a revenue recognition resource center. In this resource center are available various webinars we put on, industry guidance, industry minis, we call them, that give the high-level effects that it has on a particular industry. Please take a moment and visit our website and look at the Revenue Recognition Resource Center. That concludes our presentation for today. I would like to thank John and Mark for all their hard work.